All right, welcome back, everyone. I am Equanimity, and this is now episode 6. You know, a lot of exciting developments in the market over the past couple of weeks. We have seen gold and silver just absolutely crash. Microsoft lost $400 billion of market cap the other day, and then we made some significant developments in our overall investing process as well. So, what is this video going to be about? Well, last week or 2 weeks ago, I said that for a while now, I've been tracking 88 different stocks, and I believe these are some of the best businesses in the world. They are very high quality companies that have really strong profit margins, strong return on invested capital. Many are debt free, but I realized that if we want to take this thing to the next level, not only for my own development, but as well as for you who are watching and enjoying the channel so far, then the next step is we got to cast our net a bit wider. We got to find more companies and really expose ourselves to all the best businesses in the world. So what did I do? Well, early on in the video, or 2 weeks ago, I essentially spelled out that I had found 80 additional high quality stocks to track. And what I needed to do in the meantime is gather all their financial data over these past couple of weeks so that we can actually compare against the companies that I have been tracking for some time. Now, there was one little challenge in there that I ultimately said that if you guys were able to help me out and give this video 20 likes, then I would reveal exactly how I found those companies online so that you can track those businesses. And unfortunately, we fell short of that challenge. So I'm going to pass that challenge on again for a second time now. If we can get just 20 likes on this video, then I will reveal exactly how I found those businesses so that you can replicate it, discover companies of your own that are solid, high quality businesses, and really get started on the right path when it comes to investing. But as I said, there's a lot more work than just that. And what I'm going to highlight here is that all these light blue companies are essentially the businesses that I had found and have been tracking for the past 4 to 5 years. But on top of that, all these purple companies are the new businesses that we tracked. And you can see that the list is quite extensive. At this point, we now have 161 companies versus just 87 previous to 2 weeks ago. And all these financial numbers here, this is the work that I had to do in between. I had made that promise that I would go out and gather this information so that we could have a comprehensive video that really shows and we can compare these businesses across each other. Now, just to highlight the amount of work that it takes, each company I build out their own individual model here, and what I'm gathering is financial information that goes all the way back to 2015. As I've said before, the longer term picture you can get about a company, the more predictable it is because you can really see how they've developed over time, if they're sustaining it, where their years of turmoil and challenges have hit, and how they responded and adapted to those situations here. So for each business, I go out, I gather revenue data from 2015 to 2024, net profit, book value, debt, operating cash, and CapEx. Add this all up. I built a model that allows me to value these businesses, and that produces the intrinsic value down over here. And then on top of that, I get a good picture of the 5-year average for return on invested capital, debt to free cash flow, profit margin, the free cash flow yield, growth rate. And this just gives me a very good base foundation for where to start next, or start looking next when I want to dive into a business. Each one of these takes about 20 minutes each. And as I said, added about 80 companies. So as you can see, over the past 2 weeks, doing a little quick math, I've done about 26 hours of additional work. And now this is on top of my regular job. And I want to be very clear, I enjoy the job that I do during the day. I think it's a fantastic opportunity. I've learned so much as is, but I also am very, very passionate about investing. And I also believe that there is a major problem where a lot of investors are not pushing themselves enough to try and expose themselves to the best investment opportunities out there. Because I love doing it and I want to help you guys along the way, I am willing to do this. And you know, when I make a promise, I'm going to uphold it for you guys to develop. But just to understand, you know, regular work week, 40 hours plus another 26 hours spread throughout those 2 weeks, it takes a lot of work. And that's kind of one takeaway that you can have from this is if you want to be one of the best investors, you got to be willing to put in the work, because it will give you the best opportunities. Ultimately, the more you expose yourself, the more you learn about business and economics and understanding what makes a good company tick, how management can lead and build effective cultures. All these elements add up, and the more you understand, the better chances you're going to have at making solid investments overall. So with that said, what I'm going to do for this video is two things. First, I think that this watch list that I have built is a great kind of place to start. It gives you a really solid idea of the financial metrics. And in many instances, I believe that the finances and the numbers are the best showcase of a business's quality. It's also easily measurable against other companies. There's less ambiguity, and it exposes me and gives me a good idea of what are the best businesses relative to all these other high quality companies. But like I said, it's only a starting place, because while it's good to have this much breadth and expose yourself to all these businesses, you need to really dive into the weeds to truly understand a company. And this only gives you a snapshot. It doesn't tell the full story. It doesn't tell you who the CEO is, what decisions they've made to set the company up for success. Have they built that culture that the employees are bought in and continuing to sustain that? And moreover, what's going to happen when the CEO does retire or move on to another business? Are they going to be able to keep it up? So you have to dive in, and that's ultimately what I think this channel is going to evolve into. Is while I'm highlighting these from a high level here and you're seeing all these different companies, what I really want to show is the research and the deep dives into individual companies. So as we progress, kind of my game plan is, we're going to have a couple more weeks of just analyzing the data here, and then we're going to start getting into the nitty gritty. I am going to highlight and tell and share stories about the businesses that I currently own in my portfolio. I'm going to give you a deep dive, a fair assessment. I'm going to tell you why I actually invested in them, but as well as the critiques and maybe areas of weakness, because you want to have the whole picture. You don't want to just buy into the positives of a business. You got to understand that there's challenges and risks. And if you're not aware of them, again, you can get caught with your hands tied, and you might not know what to do when, say, the stock does fall 20%. And if you're not sure, you haven't dove in, or you're basing your current investments on what influencers are saying out there, analysts, even Wall Street are saying about a company, you're going to get yourself in a tough position if you haven't done the work yourself. That's ultimately what this channel is going to do. Long story short, two things that we're going to do on this episode. First, I think it's a great opportunity to study a recent case or event that occurred, and that would be Microsoft and how it lost $400 billion in market cap. And then we're actually going to return back to this page, and I'm going to highlight, as we went through last time, the top 10 companies in a variety of metrics, so that you can see how it's changed. And I'm telling you, I have flipped the switch. I've seen how the rankings go, and this really did blow up the list. Adding all these companies really exposed it. Now you're going to see that there are many new entrants in those top 10 lists, and it's a great perspective overall. And you can actually track them, because I've highlighted them in blue and purple, that you'll be able to differentiate the old versus the new, see where they fit, see how new companies have taken the top spots, and again, just give you a good idea of what business is overall. But as I said, what I want to start with is kind of diving more into the weeds. I want to show you an event. Is this a good opportunity to invest in Microsoft? We'll see. I'm going to share my thoughts shortly here, but it's a great example, and I think it's worth exploring here. So what happened with Microsoft? Well, the company released their Q2 fiscal year 2026 earnings report, and overall the numbers are really solid. You're going to see here revenue was $81.3 billion. It increased 17% year over year. Operating income was $38.3 billion, an increase of 21%. Net income was $38.5 billion, increase of 60%. And diluted earnings per share, $5.16, an increase of 60%. These are fantastic numbers. And for a multi-trillion-dollar company like Microsoft, given the size and scale of the business, these are absolutely insane. Fantastic numbers. But the thing is that the stock crashed. And you can see here that over the past couple of days, really on the 28th, which is I think the day they released their earnings, the stock has plummeted. And this is a year-to-date look, so we have about a month of data so far, at least from this year, and it's a significant loss. They lost $400 billion of market cap just from this single event. And you may be wondering, with all these positive metrics coming out, positive, they're still super profitable. Things seem to go really well for Microsoft. Why would the market react and have this negative view or outlook on the business? Well, essentially, the reason behind it is that Microsoft has a large backlog within their cloud computing space that they've essentially are future revenues that the company will acquire over time. And it's due to contracts that they sign with various customers spelled out over multiple years. And this is, it's good. It's good to have kind of that backlog that is predictable revenue, stuff that you can anticipate, but there's also a risk associated with it because you're essentially anticipating that this revenue is going to come in, that you're going to realize it. But if you have a customer who goes under, struggles, maybe they fold, who else, maybe regulatory pressure halts these revenues, then you've ultimately lost that. But the main point with this backlog is that the company announced that they have $625 billion of backlog. The thing is that $281 billion of it is coming from OpenAI. And, OpenAI has been making headlines now for 3-4 years now at this point, really since the public release of ChatGPT. It introduced the world to AI and generative AI and what it's capable of. And, it's all exciting, but this is an egregious number. And as you're going to see shortly here is that OpenAI, though they have made many feats in recent years, there's also some major risks associated with the company. And in some instance, Microsoft has put a lot of their eggs in one basket with OpenAI. They invested $13 billion in the company. I think they have a 27% stake in the business. So they are deeply tied and connected and have made their bet on the company. And yet OpenAI is struggling to essentially realize or achieve what they set out with the goal. Part of this is some criticism with Sam Altman, maybe overpromising and under-delivering. Another element of it is just competition is increasing. Not only is OpenAI producing generative AI, but so are Google, Meta, Cursor AI, a bunch of different smaller businesses. They are all making a push. They're highly competitive. And frankly, a lot of the technology is quite similar to each other. And so in some sense, the product almost becomes commoditized. And what I mean by that is that there's a lot of options out there. You can go and use different generative AI chatbots from a variety of different companies. You're not just solely depending on OpenAI. A lot of these businesses have been preparing for this moment for some time. And ultimately, when the shift and the boom that happened because of generative AI was declared or released in a few years back, it led to all these companies pivoting. They've invested, and as you all know, AI is in a massive boom. But going back to Microsoft, they have put a lot of their stake, and it's tied to OpenAI's success. They're very dependent in that way. And while Microsoft is much bigger than OpenAI, and they have established products between Copilot, Microsoft 365, hardware between laptops and tablets and the like. There's a lot of different elements. This is really one of the major investments that they made by investing in OpenAI so early. And now it's a question of, are they going to actually benefit, or is OpenAI's business in jeopardy? And so that's kind of where I believe it's at, is while OpenAI is a very exciting business, they've made a lot of developments, they are a lot fundamentally weaker than you might expect. And again, because of kind of this race, this hype, they've been able to attract a lot of capital, make a lot of investments. I think their recent funding round, they're attempting to have an $890 billion valuation, which is absolutely absurd for a company that started only, I think it's like 10 years ago. And relative to their revenue, relative to the net loss, how the heck they're deserving of an $890 billion valuation, I have no idea. But there's a lot of risks too with the business as well. So kind of diving into that, what I'm highlighting here is that, for example, NVIDIA had announced, or OpenAI along with NVIDIA had announced, that the company was planning to invest up to $100 billion into OpenAI. And, if you're seeing this and you've been tracking kind of the artificial intelligence boom and everything, obviously NVIDIA is the darling child, the most prized company of all when it comes to that at this time. But they ended up deciding to halt or stall that planned $100 billion investment in OpenAI. And the reasons for it, as cited per Reuters here, part of it is that competition is ramping up. Google and Meta are making aggressive pushes. So OpenAI doesn't have such a significant competitive advantage as they once had earlier on in the process. But as well, Jensen Huang, the CEO of NVIDIA, has been critical of the business's approach. And say what you want to say about Sam Altman. I think exceptional, revolutionary in many ways, but he also really does overpromise and underdeliver. There's a lot of times where he just pulls insane numbers out of his butt and then essentially banks on people buying into it, buying into the hype, and then attracting investments. But that cycle can only go on so long. And as you'll see here or shortly, is that OpenAI is a money-losing business. They do not have a profit. So that means they're churning through cash and they have to continue raising more money in order to sustain themselves. But if that stops, then you run into a situation where the business is losing billions of dollars annually, and yet they are in a position where they're trying to give an $890 billion valuation with no sustainable cash coming in for themselves there. So this is one element. Another good example of the risks that are associated, and as I talked about the competition here, is that Apple signed a deal for Google's Gemini to revamp Siri and kind of carry out Apple's AI product and services out into the future. And this is a continuation. For the longest time, Google has been the default browser on Apple's products, and they've had a strong, enduring relationship over the past 15, 20 years. And really what this signals is that they're going to continue that. The two companies have built a lot of trust from each other. They both benefit handsomely from it, have made an insane amount of money. This has been a common conversation of antitrust issues for Google when it comes to just their presence on over 2 billion Apple products out there. And now that they're taking that next level with AI, it is, it's a further reinforcement. But the alternative is at some point, Apple was in talks for OpenAI and ChatGPT to be the primary model. And I believe in the more recent iPhones that it has actually been what has supported Apple Intelligence. But with this shift, clearly Apple is saying, one, we like Google's products more. We have a lot of trust in them. They deliver on the expected outcomes that we are hoping for. And we are making a strong stance and a pivot and moving away from OpenAI. So not only is OpenAI trying to kind of maintain this ridiculous valuation, but at this point too, they're losing a potential investment from NVIDIA, a massive investment of $100 billion. And they're losing one of the gold mine opportunities when it comes to servicing Apple products out there. These are two major risks that put the company in a much more difficult position. And it actually led to a signal from Sam Altman, again, the CEO of OpenAI. He essentially called out a code red where because of this increased competition, the business is now on extra high alert, trying to push to that next level. They need to accelerate their development. They need to stay ahead of the curve, and things are looking bleak. They're kind of put their backs against the wall, and there's a lot more uncertainty around the business. Are they going to actually survive without this, competitive advantage that they once had early on? There's a lot of questions out there, and it really puts just into question how certain can you be about this business here. The last part about it, when tying in to OpenAI, and as I've said, is that they are a money-losing business. They are anticipating to lose about $14 billion in 2026, but they are saying that they're going to achieve $100 billion in revenue by 2029. Well, that's a 4-year stretch where they're losing money, and they're essentially upholding the same narrative that they've had for quite some time. But that, because of all that uncertainty and this loss of products and customers due to increased competition, how can they guarantee $100 billion by 2029 when all these other businesses are out there? And not only that, but a company like Google or Meta are super profitable businesses that have that are sustainable on their own. They're no longer dependent on investor money or debt. They can sustain themselves just by the products that they produce and the profit that they've generated. Who's to say that OpenAI is going to come out ahead versus a Google or Meta? I think it's very unlikely. And so that's the big problem here. Tying it back to Microsoft is, while Microsoft is a fantastic business on their own, their investment and the concentration in their cloud computing as it relates to their backlog and $281 billion tied to OpenAI, that is a major concern. It is why everyone is so hesitant, why the market itself has essentially panicked, the stock sold off, and left in investors' mind the question of whether it makes sense to invest or is this too risky. So tying it all together, I think that was a lot of information. Really what it comes down to is the stock fell 10%. So is it a good time to invest in Microsoft? Well, we can look here, just analyzing the company comparison. We can see where Microsoft fits in the picture today, and then essentially decide, based on its valuation, is it an appropriate investment even with the 10% sell-off? So looking at how things stand now for Microsoft, you are going to see that there are some really solid results overall. It's still one of the best run businesses in the world. I mean, to deserve an above $1 trillion valuation, really $3 trillion at this point, is a phenomenal feat, and it is only attainable by the best companies in the world today. There are so few of them. I think I have 10 companies with above $1 trillion market cap valuations. So it's very rare on its own. It speaks to what they've been able to accomplish over decades now at this point. I think they started in the early 1980s. So that's almost about 50 years that the business has been operating. As you saw in the quarterly earnings release, they're still continuing to grow, and they have a great runway due to their position in AI and the success that they've had. They have millions of customers all around the world using their suite of tools through Microsoft 365. A little bit of support in Copilot, definitely not to the same extent. Microsoft Azure is one of the best cloud computing platforms or infrastructures in the world as well. A lot of favorable characteristics, and you can see that here. Return on invested capital of 30%, and this is a 5-year average. Profit margin of 36%, another 5-year average. The growth rate's at 15%, phenomenal for the size of the company. They have a debt to free cash flow of 56%, so very little debt relative to the cash that they have. They are in a great position, very, very little risk from that standpoint. And now the question is more so about valuation, because what I try to do and how I try to capitalize on investment opportunities is I'm looking for a catalyst. I want to see when the market overreacts and is super fearful and sells off a stock, because that just essentially means that you can buy the business at a much more attractive price. But it all needs to be put in perspective. You need to be looking at what is the true value of the business, the intrinsic value, and how it compares to the market cap today. And as you're seeing right now, Microsoft has a $3.2 trillion market cap. But I think the business is worth much closer to $1.3 trillion today. So that essentially means that it is about 141% overvalued. And so even though you've seen this fall off, $400 billion of market cap value was lost in this recent news, the company, relative to the cash flow it produces and the assets it owns, is still too expensive. I think that this is one of the best businesses out there, but a $3 trillion valuation is absurd. It's one of the top 5 companies when it comes to market cap, and it's really hinged a lot on this development in AI. Over the past, since 2017 really to 2026, so almost 10 years, there have been a lot of hype and developments. The market has been on a tear in that time. It's reached new all-time highs, but it's very bubble-like in the sense. And you see that a lot with these top companies, is that they've received these egregious valuations that, while the business is still deserving of $1 trillion and above valuation, $3 trillion at this time, based on the money that they've generated and brought into the company and the present value of all that future cash flow, it just doesn't reflect a $3 trillion valuation. I think a much more appropriate valuation is $1.3 trillion. And basically what I'm saying here is that for myself, I would look at Microsoft and I'd say, wow, I would love to own this company, but not at this price. And that just essentially means that even though it is looking a bit more attractive right now, I would much rather wait some time, see whether the business can realize cash flow that supports a $3 trillion market cap, or the more likely outcome is that Microsoft stock has a good chance of regressing or falling more, especially if everything unfolds. For example, let's say you invested in Microsoft at this time, but shortly more developments come out, more customers are moving away from OpenAI, they're investing less. OpenAI's net loss continues to increase more than what they anticipated. Many factors kind of play into it, and things go really, really bad for OpenAI. The business either declares bankruptcy or essentially loses all its competitive positioning in the market. Well, this is definitely going to have an impact on Microsoft stock because of their $13 billion investment at the time. I think the valuation right now of that investment is $153 billion. So a fantastic return so far, but because of the losses and the risk that is tied to the place in the market, if OpenAI comes out with that bad information, all this deep dependency or association with OpenAI is only going to hurt the stock further. And I think this is more realistic. We'll get into at some point my thoughts on the overall AI bubble and where I think these companies are going, at least in the near term. But for now, you can see that because of this position, I think that there's a good chance that a lot of these AI companies are probably going to lose value before they continue to attract more value out into the future. I don't know when it's going to happen, but fear tends to spook people. And this is a prime example, like Microsoft losing 10% in a day, even though the positive numbers that they produce it's more a reflection of how overvalued Microsoft is at this time relative to the fundamentals of the business, because it's still an excellent company, but because that valuation is so high, there's going to be a point in time where I think the market panics a little more. There's a good chance that Microsoft stock depreciates in value even further. And you know what? That's what I'm essentially hoping for in some instance, because then it gives me an opportunity to buy the stock at a much more attractive price, much more realistic price, which gives me confidence that I can then generate above average returns. So that's kind of the summary there. Right now, my stance on Microsoft is that I would not buy. This is not investment advice, but I just think that I would much rather want to wait on the sideline, wait for a better opportunity, wait for that valuation to regress further. But on top of that, we track 161 stocks here. So it's not like I have to put all my cards or time into Microsoft here. There's a lot of different businesses that have much more attractive valuations at this moment that provide both that fundamental strength, but as well as that attractive valuation that ultimately comes together and builds a successful investment opportunity there. So now that I've gone through Microsoft, you can kind of hear my stance, especially on this recent information that is tied to the business. I think it's time now to dissect the new companies that have been added to the list. And once again, I just want to highlight that right now you are seeing an additional 80 companies that have been added to this watch list here. They range from a lot of things. You're seeing there's insurance companies, a lot of insurance and finance related companies. There's an airline business. There are agricultural stocks, construction stocks, software, infrastructure as a service stocks, auto, a bunch of different opportunities out there. And all of them, what I really want to highlight is just look at these performance metrics here. Again, this column here is return on invested capital, and you're seeing many, many different companies with above a 10% return on invested capital. Similarly, when it comes to net profit margin, there's a lot of businesses with above a 10% net profit margin in here. Essentially, what I'm looking for is I want to find very profitable companies, and you're seeing that 80 new businesses out there have really solid fundamentals overall that anyone can go out and find. It's helpful if you know how to find them, but don't discount yourself, even though the prime investment opportunities are Microsoft, Amazon, Meta, Google. all these magnificent seven stocks and those that most analysts track, there's a lot of also hidden businesses out there that are super, super attractive. And that's what you're going to see now, because even though those best or fantastic $1 trillion and above companies are out there, you can see that in many cases, these smaller businesses actually outperform them. So first and foremost, we are going to look at return on invested capital here. And you can see that there are many new entrants to the list. While we still are retaining some of the businesses, Apple was number one last or 2 weeks ago. There have been new entrants all throughout here, and we're going to read through that list. So the top 10 companies with a 5-year average return on invested capital are Apple with 65%, Medifast with 58%, number 3, Novo Nordisk with 56%, number 4, Manhattan Associates with a 55% ROIC, number 6, Ulta Beauty with 48%, number 7, MasterCard with 47%, number 8, Fortinet with 46%, number 9, Texas Pacific Land Trust with 43%, and Dollarama at number 10 with a 41% ROIC. Fantastic numbers. Again, the benchmark is 10%. So anything above that, all of these companies are above 40% when it comes to their 5-year average return on invested capital. Absolutely insane. This is my number one favorite metric to track because I really do believe it is the best reflection of strong fundamental performance. And if you were generating that over not just a single year, but 5 years, 10 years out, man, you are in a good spot. Definitely, I highly recommend exploring these businesses, researching them, and then coming to your own determination of whether you want to make that investment in the company. Moving on to profit margin, my second favorite financial metric here, you are going to see that there are a ton of new companies on the list. A reminder, the purple are the new businesses, blue are the former companies that were already there, but you have a new top entrant. You also have many others filling out the rest of the top 10. So with that, the top 10 companies with the highest 5-year average profit margin are at number 1, Texas Pacific Land Trust with 63%, number 2, Visa with a 52% profit margin, number 3, Nimi Holdings with 51%, number 4, Euroseas with 45%, number 5, MasterCard with 45%, number 6, East West Bancorp with 44%, number 7, Fudu Holdings with 40%, number 8, Bank 7 Corp with 40%, number 9, TSMC or Taiwan Semiconductor Manufacturer with a 40% profit margin, number 10, Global Ship Leased with a 39% profit margin. 10% is great, 39% and above is phenomenal. That essentially means that for every $1 million of revenue that they are bringing in, $400,000 of it and above are coming in that they get to hold on after all their operating expenses, their taxes, their interest rates are paid for. That is a lot of money coming into the business that can then be used in the future to fuel future growth and build a sustainable business over the long run. One other thing about profit margin is that, again, maybe times get hard, maybe the economy slows down, consumers pay a lot less. Well, the good news is one, either if they can retain or maintain that same profit margin while they are in a great spot during tough times. But even if they start to lose revenue and their expenses stay at the same rate, well, they have a lot of wiggle room. They can go down to 30% profit margin, 20%, 10%, and they have a lot of cushion. Whereas many of their competitors might not have that flexibility. They're going to have to be a lot more conservative during a recession or economic downturn, and they're going to fare well, be in a good position, resilient overall. Now, moving on to growth rate, another useful tool, definitely, as I've always talked about, it is important. It is a good scope of how quickly businesses are growing here. Well, you can see here that once again, many new entrants to the list. This is exactly what I was hoping for. I wanted to blow up my existing list so that you could see just how many good businesses are out there. Don't close your mind up. Continue to be open, continue to explore. There's a lot to learn, a lot of interesting companies to potentially invest in. So with that, the top 10 companies with the fastest long-term growth rates are CrowdStrike at number 1 with 67%. At number 2, Atour Lifestyle Holdings with 64%. At number 3, PDD Holdings with a 64% growth rate. At number 4, NVIDIA with a 59% growth rate. At number 5, Doximity with 51%. At number 6, Shopify with 41%. At number 7, Trade Desk with 39%. At number 8, Oddity Tech with a 36% growth rate. At number 9, Houlihan Lokey with a 36% growth rate. And number 10, Sterling Infrastructure with 35%. Phenomenal pace, and if they can keep that up over the next 10 years, you can best believe that they will have super attractive valuations, especially if you can get it at a good price today. Moving on to debt to free cash flow, the last of our financial metrics here. I talked about it last time, but if you have zero debt on your balance sheet, you don't need to raise any additional outside capital because your business is so sustainable internally, your products are attractive, and you can build them at an economically feasible price. Then without debt, you have very, very little risk of going bankrupt here. And last time, we had 28 companies that had a 0% debt to free cash flow. Unreal already, but now we have moved or increased that number to now 51 different companies with zero debt on their balance sheet. This is awesome. Again, it is really, really good. And if you combine it with an attractive return on invested capital, attractive profit margin, and attractive growth rate, you have found the gold mine here. So real quickly, I'm just going to list out these businesses that all have a 0% debt to free cash flow because they are worth exploring. You can at least hear them, start to familiarize yourself, and then start digging in further. So with that, the 51 companies with a 0% debt to free cash flow are Atour Lifestyle Holdings, PDD Holdings, Doximity, Shopify, Trade Tech, Oddity Tech, Houlihan Lokey, Nextpower, Monolithic Power Systems, Arista Networks, Palomar Holdings, Palo Alto Networks, Deckers Outdoor Corp, Nova, Paycom Software, Copart, Esquire Financial Holdings, Texas Pacific Land Trust, International General Insurance, Cactus, Logitech, Badger Meter, Cal-Maine Foods, Powell Industries, MedPace Holdings, Red Violet, Chipotle, Excelis, Clearfield, Alta Beauty, Bank 7 Corp, Nice, Qualis, Erie Indemnity Company, Fudu Holdings, Aradimed, Manhattan Associates, Primerica, VIP Shop, Intuitive Surgical, Moelis, Taylor Devices, Excelixis, Reddit, Berkshire Hathaway, First American Financial, Robert Half Insurance, USA NA, Medifast, Perion Network, and Snowflake. Whew, that's a lot. Definitely worth checking out. A lot of companies that I definitely am excited to explore further. So now that we've covered the financial metrics, the next step is to look at the valuation metrics. Which companies are trading at the most attractive valuations today? Well, you will see here that there are some businesses producing above a 10% free cash flow yield. And so why do I say 10% here? Because over the long term, the S&P 500 has averaged about a 8 to 10% annual return over its lifetime. And this goes all the way back to the early 1900s there. So a very long window of time, but that is ultimately our comparative tool there. So if you can find a free cash flow yield that is above that, it indicates that you are essentially going to generate that return in the following year, or that is what they were capable of generating based on if you purchase the company at its current valuation today relative to the free cash flow it produced in its last fiscal year. So many exciting companies, again, a ton above 10%, a lot of new businesses here once again. And with that, the top 10 companies with the most attractive free cash flow yields are at number 1, Afia with 34%, 2, Euroseas with 31%, Cal-Maine Foods with 27%, Snowflake with 21%. At number 5, Arch Capital with a 19% yield. Netflix with a 19% yield. 7, International General Insurance with a 19% yield. Futu Holdings at number 8 with an 18% yield. At number 9, RBC with 16%. And number 10, HCI Group with 16%. All well above average, all attractive free cash flow yields. When you compare it again with really strong fundamentals, financial performance, with a good price, you are in the best position. You're giving yourself the best opportunity at having a successful, high certainty, highly predictable investment opportunity there. Lastly here, as I always talk about, is while I like free cash flow yield, my number one favorite metric is to really actually value the business. I always like to look at the companies as a whole and see where they're at from their intrinsic value relative to what their market cap is today. And I mean, man, this is entirely almost purple here. that just goes to show that there are a ton of new businesses that we have discovered that are trading at really attractive prices and definitely worth exploring. So the top 10 companies with the top 10 companies with the most attractive valuations today are: at number 1, Afia, trading at 94% below its intrinsic value. Medifast at number 2, below 86%. International General Insurance at number 3, 85% below its intrinsic value. Number 4, PDD Holdings with an 84% undervaluation. Number 5, Kinsale Capital Group, 83%. Number 6, Cal-Maine Foods with 78%. Number 7, Stride with 77%. Number 8, HCI Group with 77%. Number 9, Palomar Holdings with 72%. And lastly, Arch Capital with 70%. Unreal numbers, really, really solid. And one thing to note, I do think it is important that while these are showing and highlighting really attractive valuations, is just understand that the growth rate is a strong indicator of the company's intrinsic value. Once again, what I'm doing is essentially, what are the free cash flows today? What long-term growth rate have they achieved in the past? If they achieve that into the future as well, if it's a higher rate, they're going to grow a lot faster. Their valuation is going to look a lot more attractive. So while it's a good look, one thing it is important to keep in mind is a lot of these businesses are going to release their 2025 annual financial data really shortly here. That's what this column here highlights. So a lot of these 4s here mean that essentially their Q4 is when they release their 10K. And so once that data is publicly made available following their earnings release, we can update these numbers. So just be cautious here. Ultimately, is that while these valuations look really, really attractive right now, once this updated information is added, it may shift things a little bit. And so for myself personally, what I'm essentially doing is, while I'm looking at this and saying, ooh, these are interesting stocks, I want to see what this most recent information provides, this financial data, to give me a solid perspective, and then I can make that decision of whether it is a worthwhile investment or not. But overall, really attractive valuations. And once again, if you can combine it with attractive financials, fundamentals, and you're seeing here, there's a lot of businesses with above 10% 5-year return on invested capital and profit margin. Some have no debt, some have, some debt, but mostly reasonable. Only a couple of companies above 100%. And even then, that's not overly risky. I would start to raise some red flags if I'm seeing above 300% and beyond there, but generally pretty good there. So we've looked at the individual elements of this. Now is the time to assess from an overall standpoint who is the top ranked businesses here. And with that, you can see many new interests or many new businesses entering the top 10 list overall. With that, the top 10 companies as of the first week of February are: at number 1, Texas Pacific Land Trust; at number 2, Bank 7 Corp; at number 3, Deckers Outdoor Corp; at number 4, Euroseas; at number 5, Doximity; at number 6, Paycom Software; at number 7, Catalyst Pharmaceuticals; at 8, Kinsale Capital Group; at number 9, Copart; and number 10, Cal-Maine Foods. This is a combination, a weighted assessment between return on invested capital, profit margin, growth rate, debt to free cash flow, and their valuation. If all stack up, if all look attractive, that's what gets you in this top 10 list. And even beyond that top 10 list, it is worthwhile exploring the other businesses there, because there is a lot of fantastic companies. And I think, just to summarize it, because we've really covered it, I do want to have one additional step here where all these companies that are releasing their data or their 10Ks as of the fourth quarter financial data, what I want to look at is how this thing evolves one more time, because you are seeing a lot of good businesses. But that is going to be the key element of next week's video. And then from that point on, we are going to dive into the individual businesses. And one thing you must understand is that even though the top 10 list is determined based on the model that I've set up, how it's assessed, I don't necessarily always invest in the top 10 stocks. As I said at the beginning of the video, it's one thing to look at the breadth, it's one thing to look at the high level element of this, but ultimately you have to do that deep dive. You have to assess all the core elements of the business to understand the quality of it, really understand their management team, the economics of their industry. Is it an attractive industry where they can generate and sustain a high profit margin, return on invested capital? What's the outlook for that industry, and what makes them special? What is the company's competitive advantage? All these factors go in addition to the financial data here, in addition to the valuation. But if you can combine those and then find something that you feel very confident about, you like all the elements of it and believe that it can sustain itself, not for just for the next 5 years, but 10 years, 20 years and beyond. If you can find those companies where, you can make it a purchase at an attractive price, hold on to the business for the long run and allow it to compound, allow it to do the work that it has set out to do, then that is the best position. It is overall my belief that the less activity you do in the market, the better chances of success you have. And while it's not about necessarily being active, you still want to put in the work. If you're doing all that research in the meantime and studying these companies, really trying to understand them, then when those opportunities come about where, once again, maybe a company loses a significant amount of its market value and becomes trading at attractive price, well, then you've bought it with a high degree of certainty, because not only do you understand the financials, but you also understand the qualitative aspects of the business as well, and also know that you're purchasing it at an attractive price. So I think this is a good way to kind of cap off this video. Once again, we hit 100 subscribers, one of the main objectives that I had set out initially with this channel on YouTube. So that is a testament to all of you. I'm going to continue to try and make these videos more and more useful, more educational and informative, so that you have a really strong perspective, not only of my investment philosophy, but as well exposing yourself to new businesses that you have never heard of. But with that, thanks a ton for all of your support. I'm really excited to continue doing this thing. Keep growing this, and if you did find the information useful, please give it a like, subscribe, and comments go a long way to help us reach more people out there. This is Equanimity, and I am signing out.